Let me be direct about what this video is and what it isn't. This is not a takedown of crypto. This is not a pitch for crypto. This is the data, unfiltered, specific, and complete, because you deserve to make decisions based on what's actually true rather than what sells courses or gets engagement. There are things the crypto community doesn't want you to know. There are also things the traditional finance world doesn't want you to know about crypto's legitimate track record. We're covering both. Let's start with the return comparison, because it's more complicated than either camp admits. Bitcoin's 10-year annualized return through 2025, approximately 49% per year. That sounds extraordinary. The S&P 500 over the same period, approximately 13% annualized. On the surface, Bitcoin wins by a massive margin. But those numbers don't tell the full story. Bitcoin's returns are extremely period dependent. If you bought in December 2017, the height of the first major retail bubble, and held for 3 years, you were down 55% at the 3-year mark. From January 2018 through December 2020, the S&P 500 gained 63%. Bitcoin gained 14%. A 3-year period where Bitcoin dramatically underperformed traditional equities. The volatility gap is the critical variable. Bitcoin's standard deviation, the statistical measure of price swings, is approximately 5 to 7 times higher than the S&P 500's. That means for every unit of return, you are accepting 5 to 7 times more risk. On a risk-adjusted basis, which is the correct way to compare investments, Bitcoin's Sharpe ratio historically ranges from 0.6 to 1.0. The S&P 500 consistently ranges from 0.5 to 1.5. Risk-adjusted, they are broadly comparable. Sometimes Bitcoin wins, sometimes the index wins. The framing that Bitcoin is a 100x opportunity ignores the risk-adjusted reality. It's a legitimately interesting asset class with genuinely high volatility and genuinely high return potential, but the edge over diversified equities, once you adjust for the risk you're accepting, is much smaller than the headlines suggest. Bitcoin is not the representative cryptocurrency. There are currently over 22,000 cryptocurrencies listed on tracking sites. Of the top 100 altcoins from 2017, approximately 95% are now worth effectively zero or have been delisted entirely. This is not a speculative claim. It is a documented historical fact. Coins that were in the top 20 by market capitalization in 2017, NEM, Waves, Siacoin, DGByte, trade at fractions of their peak prices. Many have been abandoned by their development teams. Many were outright scams from the beginning. The rest simply couldn't sustain adoption against better-funded competitors. The altcoin market operates like a lottery with worse odds than advertised. For every Ethereum that gained value from early adoption, there are hundreds of coins that went to zero, taking their holders' money with them. The success stories get retold endlessly. The failures, which are overwhelmingly the majority outcome, get forgotten. This matters for your decision-making. When someone tells you about the altcoin they're confident in, they are implicitly betting against a 95% historical failure rate. That is not investing. That is speculation, specifically the kind of speculation where the expected value is negative for most participants. The exchange risk is the component of crypto investing that traditional finance cheerleaders are least likely to acknowledge and that crypto enthusiasts most often minimize. When you hold crypto on an exchange, Coinbase, Binance, Kraken, or any other, you do not hold crypto. You hold a promise from that exchange to give you crypto. Your asset is only as good as the exchange's solvency. FTX was the world's second largest crypto exchange in 2022. It was valued at $32 billion. In November 2022, it filed for bankruptcy in 4 days. Customer funds, approximately $8 billion, were misappropriated. Real people who thought they had real money discovered their balances were effectively fictitious. Many will never recover those funds. Mt. was the world's largest Bitcoin exchange in 2014. It processed 70% of all Bitcoin transactions globally. In February 2014, it suspended trading, closed down, and filed for bankruptcy. Approximately 850,000 Bitcoin belonging to customers, worth roughly $57 billion at 2024 prices, had been stolen or lost. A decade later, creditors were still waiting for partial reimbursement. These are not anomalies. Exchange failures, hacks, and fraud are a recurring feature of the crypto industry. Since 2011, over $5 billion has been lost to exchange hacks alone. The assets held at these exchanges had no FDIC insurance, no SIPC protection, no regulatory backstop. The lesson: if you hold crypto, hold it yourself. Not on an exchange. In a hardware wallet you physically control. Not your keys, not your crypto, is not a slogan. It's a factual description of custodial risk. Let's be precise about who the actual winners in the crypto ecosystem are, because the distribution of returns tells a different story than the promotional narrative. Early adopters. People who bought Bitcoin before 2013, or Ethereum before 2016. These individuals hold assets that have appreciated tens of thousands of %. They made extraordinary returns. There are not many of them, and by definition, their window of entry is closed. Exchanges. Every trade on every platform generates a fee. Coinbase reported $3 billion in revenue in 2024. Binance processes billions in daily volume with fees attached to each transaction. The exchanges make money regardless of whether the assets go up or down. They have the business model that works in all market conditions. Infrastructure providers. Mining equipment manufacturers, node operators, blockchain developers, these participants extract value from the ecosystem in exchange for services, not from speculative price appreciation. Influencers and course sellers. The financial incentive to pump a cryptocurrency and then sell courses explaining why it will keep going up is enormous. Many of the people you see on YouTube and social media promoting specific altcoins are paid in tokens by the project teams, a fact often disclosed in small print, often not. Their financial incentive is for you to buy, not for you to profit. The retail speculator who buys altcoins based on social media recommendations in 2025 is statistically the last buyer in a distribution chain. They are providing exit liquidity to earlier holders. This is verifiable from on-chain transaction data in most high-profile cases. Regulatory clarity has improved for Bitcoin specifically in 2024 and 2025. Spot Bitcoin ETFs launched in the US in January 2024, bringing institutional legitimacy and making Bitcoin accessible through traditional brokerage accounts. That is a meaningful development. For the broader crypto market, regulatory uncertainty remains real and substantial. The SEC has pursued multiple enforcement actions against altcoin issuers on the grounds that they constitute unregistered securities. DeFi platforms face ongoing uncertainty about whether they qualify as financial exchanges subject to existing regulations. Stablecoin legislation has moved forward but not resolved every outstanding question. The regulatory risk for altcoins specifically is not priced into most retail investors' thinking. A ruling that classifies a specific coin as an unregistered security can result in delistings from US exchanges, causing prices to collapse overnight. This happened with XRP in 2020 when the SEC sued Ripple. XRP dropped 60% in a week and was delisted from Coinbase before eventually recovering years later after a partial legal win. You are not just making a bet on technology. You are making a bet on technology and regulatory outcomes and market adoption and exchange solvency and development team integrity. Stack those conditional probabilities and the odds change significantly. Here is the only framework for crypto exposure that I can defend with data. 1. If you want crypto in your portfolio, limit it to a maximum of 5% of your total investable assets. This is not arbitrary. At 5%, a total loss of that position, which is possible, costs you 5% of your portfolio. That is survivable. At 20% allocation, a total loss is not recoverable on a short timeline. 2. If you're going to hold crypto, hold Bitcoin. Not because Bitcoin is superior technology, it isn't, in many technical respects. Because Bitcoin has the longest track record, the broadest institutional adoption, the most regulatory clarity, and the most liquid market. It has demonstrated the ability to recover from severe drawdowns. The altcoin market has not shown that same resilience as a category. 3. Use self-custody if holding Bitcoin directly. Buy a Ledger or Trezor hardware wallet. Move your Bitcoin off exchanges. The risk of exchange failure is real and entirely preventable. 4. If you prefer convenience and want exposure through traditional finance, Bitcoin spot ETFs now exist. BlackRock's IBIT and Fidelity's FBTC are the two largest as of 2026. You can hold these in a brokerage or IRA. No self-custody required. Fees are low, around 0.25%. 5. Do not own altcoins. The expected value of altcoin speculation for retail investors is negative based on the historical record. The 95% failure rate is not cherry-picked data, it is what happened. Here is the honest verdict. Bitcoin is a legitimate, volatile asset class with real historical returns that, on a risk-adjusted basis, broadly compete with equities. It carries unique risks, volatility, exchange counterparty risk, regulatory risk, and the absence of traditional investor protections. If you want a small allocation with full awareness of those risks, that is a defensible decision. The broader altcoin market is a speculative arena where the historical expected value for retail investors is negative. The influencer economy around crypto has financial incentives misaligned with your interests. Exchange risk is real and has destroyed billions of dollars in customer assets. The blockchain technology underlying all of this is real. The question of which specific applications create durable value, for which investors, under which conditions, that question remains open. Promising a specific coin as the answer to that question is something you should treat with significant skepticism regardless of who is making the claim. Invest primarily in diversified equities. Keep crypto below 5% if you want it at all. Use Bitcoin over altcoins. Use self-custody or regulated ETFs over exchanges. And never invest in anything you can't afford to lose entirely. That's the truth. Not the one that sells courses. The one that protects your financial future. Word count, 1:3:10 duration, 10-minute end card, next video, dollar cost averaging, the crash data, V41.